Thank you so much for joining us today for Savvy Real Estate Investing. So before we begin, I always start these seminars with a quick market update, and so I will be doing that today. The figures that I use are for single-family homes in San Mateo County, and you do have all of this in your notes as well if you want to follow along there. So the first metric that I always like to use is median sale price, and median sale price is when you take basically the price at which you have the same number of homes selling above it as you do under it, that price. So if you look at this goes back to 2010. In 2010, we were flirting with about a little over 500,000. And then since then, back by the time we hit 2020, we were close to 1.5 million. And after that, we've been up and down flirting with 2 million. And if you just have to sit with that sometimes and go, wow, because think about that for a median sale price home. It's pretty incredible that we're at that level right now. For February, we hit over 2.1 million. So April of 2022 was actually one of the peaks there, was one of our all-time highs, and that hit 2.25 million. And then when we got to May of last year, we hit another all-time high at 2.3 million. And then it's kind of fits and starts going, you can see that it goes up and down. There's some seasonality, there are market trends. There's COVID, which I used to have a vertical line there. I don't even have it in there anymore because it really is, you just see it kind of dip and up and down and it keeps going up. So we did have, in February, the median sale price was about 2.1 million. And last month in March, it was 2,062,500. The median sale price. So again, that's pretty amazing in terms, considering all the ups and downs, the interest rates, a pandemic, et cetera, but real estate continues to grow, which is great. Months of inventory is the second one, and I only have a few, so stay with me. Months of inventory is when you take the number of homes that are currently on the market, don't add anything else, and then how long will it take you to sell out? How long will you run out of inventory, right? So the way that we consider is that green line at the top that you see, that's a balanced market, traditionally, what's called a balanced market. Above that is when you have a buyer's market, and below that is considered a seller's market. So if you look at that, since 2012, we've been in a buyer's market or a seller's market? Seller's market, right? And there have been times along the way where people go, oh, houses are sitting a little longer. And I had an agent say, we're in a buyer's market now. And I'm like, no, we're not in a buyer's market. We're not there yet, And so we've been literally between 1 to 2 months overall. During the 2021 period, so the end of 2020 and almost the whole year of 2021, we had record low inventory, so we were really at 1 month and below. So it was not uncommon to hit like 3 weeks of inventory. Once the interest rates, and I'll go through that later, but as they started to change, then we see a little bit of a shift, but still 2 months of inventory is quite low. And in other parts of the country, they experienced low inventory after COVID, and they were saying, oh, multiple offers, it's low inventory, et cetera. And I was going, we've been doing this since, for 10 years already, and it continues. So that's a big story there. And that's probably one of the biggest reasons why we see the prices continuing to hold pretty well. Days to sell is the third one, and that has to do with how long it takes from when you put a house on the market to the time that you accept an offer. So it doesn't count close of escrow, it doesn't count the escrow period. And as you can see there, the lower bar there, horizontal, is 10 days on market. So if you think about it, 10 days on market is a week and a half. It's one open house, maybe 2, right? So, and you did see some that were going 0. There is one dip in there that you'll see that was due to our pandemic. I've said pandemic already a few times. I'm trying to forget that, but that dip that you see is not because there were 0 days on market. It's because the multiple listing service decided to pause for a little bit when we had the lockdown, because we weren't sure what was going to happen. We weren't sure if we're going to be able to, we couldn't do open houses, we couldn't show houses, and so it wasn't really fair to say it was on market, and so that's why you see that 0. But other than that, it's been about 10 days on market, and if you, just going into last month, so, oh, I don't have that. So anyway, so it's, yeah, right around there. And then interest rates. So this is a big one. I like to say that when it comes to our prices and our real estate market, it's really 3 things that are all I words. So we have inventory, we have interest rates, and then we have inflation that hits us as well. So interest rates have been interesting. This goes all the way back for 10 years. And as you can see, it was very low and hit very low in 2021 to where people, I'm sure many people here have mortgage rates of 2 or 3%, right? And then in 2022, in the middle, we started seeing it jump, and it literally in a matter of months doubled, almost tripled in some cases. So it did double. And then since then, it's stabilized somewhat. So we saw the market when the interest rates started shooting up. We saw the buyers starting to freeze up a little bit and feel concerned and not move so much because they didn't know what was going on. And then now everybody's kind of used to it. So seeing the 6.5, maybe 7, between the mid to high 6s is basically where it's been jumping up and down. And the buyers have gotten more used to that fact. But at the same time, the prices have gotten so high. So we do see buyers who are out there who are interested, but they've gotten a lot more particular about things. And that we've just seen that trend more and more. So this is my last slide. I know that there is, I do a networking group meeting with a bunch of realtors every Wednesday morning, and we talk about what we're experiencing. We get guest speakers and whatnot. And today we're talking and said, we have a mortgage agent there, mortgage loan agent there with us, and we have him do an update. And he said the word uncertainty, and volatility several times. And then he was telling us how one of the head economists at his bank, Wells Fargo, ended the call with, hang in there, right? So everybody is a little bit anxious, and there's a lot of different things that are going on in terms of the economy. The stock market is going up and down. But one of my colleagues really said it well, which is go with what you know, not with what you don't know. And I really love that because it's like, okay, I don't know what the market's going to do, all of that stock market's going to do. I don't know what the interest rates are going to do. But even with all of the volatility, last week we went from 6.6 to 6.5 to 6.7 or 8, which is not a lot, right? And so I think that's okay. The one thing that we are seeing is that when there's uncertainty, some people tend to not want to do anything because you want to just sit and wait until, it's kind of like when the boat is rocking, you want to wait until it stabilizes before you move. So we may see a little bit of impact of that. We are seeing some buyers whose down payments were coming from their RSUs, their restricted stock units, or the stock market. So we're seeing a little bit of a shift there, but so far, not too bad. I have had listings in the past 2 months that I've been working on, and everything, whether as a listing or as a buyer, we're selling it within 6 to 10 days. So it's still out there. And so I'm talking a lot today. I'm a little tired because I've been working hard, which is good. So I'm happy and to be able to have listings that are moving quickly. Again, some things are going to take a little longer than others, but definitely we are seeing the demand out there. We're seeing the prices stay pretty steady. So with that, I'm going to go ahead and ask Joe to come out. So Joe has been really a good friend, and I started this seminar series in 2016, and then that's where Cindy actually came. Cindy was a fellow Mills High School mom with me, and she brought Sandy, and then Sandy and Joe, I got introduced to Sandy and Joe, and Joe's been really such a valuable friend and resource and support for my business and for my finances, all of that. And so I've really appreciated him and his willingness to share, his willingness even in the middle of retirement to be bothered to come out. And I really am so thankful to have him here today. And I hope that you'll gain as much as you can out of him. So thank you. Yeah. Please welcome Joe.
Thank you. So there's kind of a little story behind this. So we have a client who I'm the CPA and she is the broker. So they have a place up in Fairfield, and so we had took a trip up there to meet her there. So we had this hour plus trip there, and so we were talking about. Well, she said, "Do you want to do another seminar?" I said, "Well, I've kind of talked about everything. I think there's a saturation point. People aren't going to show up." And so we started to develop this whole idea of putting together everything we've ever done, kind of in some sensible fashion. Mm-hmm. And that's what kind of today is. Yep.
And it's kind of a high level thing, right? Where
right, yeah,
it's
sure,
more
sure.
thinking, not so much the details of all the taxes, but right. How to think about what you do.
Right. So. And the thing is that we were talking and everything just kind of gelled. Mm-hmm. And at the end she goes, why didn't I just record that?
I
We
know.
can make so we had to remember everything that we're trying to figure out and all that stuff. So
Yeah, it was
that's,
a 2-hour conversation. Oh, I meant to add in my introduction, during that time I learned that Joe knew he wanted to be an accountant since high school, which I think is pretty incredible, right? And he's continued to do it now. So he definitely has a heart for it. And so I'm
There we
happy
go.
that we're here.
Thank you. Okay, so as Jean said, this is going to be more like an interactive situation to where I'll tell stories, I'll go through information, and my hope is and prayer is that today you'll learn something you didn't know yesterday. And so if I can do that, then I think I've accomplished what I want, and then we'll kind of go from there. So, you know, and it's called the tax savvy investor, but in terms of real estate. But we're going to go over kind of everything in terms of other investments, because certainly, in today especially, there are alternatives to real estate. And so we'll kind of deal with those. And when you talk about real estate, there's tons of alternatives right there too. So they have the slides that we have, right?
Yep.
Okay, so you have the one with
invest in
our
real
buddy
estate?
here for Berkshire Hathaway. So he doesn't necessarily go through real estate. He has his company, but I'm sure his company invests in REITs, which is real estate investment trusts. So in effect, he does have probably somewhere in there. So, you know, why, and you don't mind me if I hold my notes, because it's easier for me to see. So why do you want to invest in real estate? And the first one is, the first thought is, well, you want your idle cash to work for you, to work harder than you do. And we'll get into kind of the whole passive versus active as far as real estate goes and income goes. But I think, you talk about appreciation, you hear the word appreciation and other alternatives. We'll talk a little bit later about, the concept of cap rates as it relates to real estate. And the second one is, second reason why, I hear this all the time for clients. They say, well, why do you want to invest in real estate? And they go, well, I want the tax deductions. I said, well, let's think about that. So you want to buy real estate so you can lose money so that you can take tax deductions. And they go, never thought of it that way. And I said, well, the other thing too is, in 1986, we had a tax law change that basically said that if you make more than a certain amount of money and you have tax losses, you cannot take them until you have income, positive income, or until you sell the property. Then you get to take all the tax losses from that property that you want. It's called that's the passive loss rules. So that's another reason why people want to get into real estate, and that's not a good one. You want to go into real estate more for other good reasons. And I just put the third one in, because there are people who, I get especially new clients that have come in the past, they just want to tell me all about their real estate, and that's fine, that's good. But I'm sure they're like that with their friends also. So good reasons to invest. Okay, you definitely want to work your idle cash. So if you have idle cash, there's CDs, there's many different things you can do. But one of them is investing in real estate. The issue, especially when you're in your younger years, is that you probably don't have enough to actually buy a piece of property. So you have to be a little bit creative. Maybe you find your parents that want to invest with you, or other friends that want to invest with you, or you get into something we'll get into a little bit called DSTs, Delaware Statutory Trusts. Okay, so that's one thing. To create positive cash flow. So like if you have rental income and you're getting positive cash flow, what's happening there is what you're trying to do is build up income for later. So as the property increases in value and your cash flow goes up, what's happening is, like if you're in your 20s and 30s, you have a W-2 income. But your W-2 income stops when you retire. So what you're trying to do during your lifetime is create passive activities that create cash flow to take over for what your W-2 income is, so that by the time you retire, your income doesn't go down that much, it just changes character. Rather than W-2 income, certainly you can have Social Security, you'll have pensions, you'll have your 401ks, your IRAs, but if you can create passive income to take over and passive means you're not actually doing the work, it's kind of working itself. Active income is like W-2 income, or if you're a consultant. So what you're trying to do through your lifetime is build up passive income to overshadow your active income so that you can retire and have the same kind of standard of life. To grow your estate. The other reason why you want to invest in real estate is that over time you want to accumulate assets in an estate so that, for a couple of reasons. One is, as you get older, that again creates the passive income that you want to take over your active income. The other one is that you just don't know if how much money you're going to need for your lifetime. As you know, especially in this area, it's not uncommon for somebody who's in a care home to pay $10,000 a month. That's $120,000 a year. That's a lot of money. So you may not have that laying around. So the assets you acquire, the real estate, rental property, maybe your home, maybe reverse mortgages, that's what's going to help to pay for those kinds of expenses that are going to happen, later on. And so let me tell you an example of the growing the estate. So I have, they're gone now, but back when I was 29 years old, I had these 3 clients, three Italian guys. They were all plasterers in San Francisco, but they were really gun-ho guys in terms of real estate. So they lived in the Potrero district, and as they were building homes, there was just hillsides at that point. They built homes, and they did it together, and they accumulated a few blocks of homes. And so at that point, their estates were set. But the issue, and we'll get to the solution a little bit later, but the issue there was they all had their families and they were all connected to each other. But they had enough foresight to go ahead and build all these properties, put their time and efforts into it, and create, again, passive loss so that when they retired on a very small plasterer's pension, they were still able to do well. Okay, so, right. And to take advantage of leverage. What is leverage? Leverage is the ability to get a loan. So you might have $200,000 as a down payment. Well, if you have an 80-20 loan, you could buy $1 million piece of property with 80% of it being the loan and the other 20% being the cash down. That's leverage. Okay, so what that does is says, okay, if I take my $200,000 and I buy a piece of a home with other people for $1 million, and that home goes up 10%, I've earned $20,000 on my 100. Okay, but if I buy the home myself and I get an $800,000 loan, and I get I use my 200 and I get and I have a 20% increase, now I've just doubled my money, my cash. I put 200 in. That's leverage. Leverage allows you in a profitable setting to actually do really well and multiply your money. Now, the biggest thing here is your age matters. So it's different if you're in your 20s and 30s than if you're in your 60s and 70s. When you're talking about leveraging and all, your whole mindset is different. And I don't have to explain that to you, all of you that are in those categories of ages. It's just inherent that we think differently than, say, a 20 or 30-year-old person. Why? Because if they lose a little bit of money, they've got plenty of time to make it up. We don't necessarily. Okay? So there's that. Okay. So choosing the right property, and I put there for you, because everybody's different. There are as many different situations, and in going through and coming up with examples, all of the examples I'll give, there's so many different, everybody has a different story, okay? And whatever your story is going to then help you to determine how you take the information you'll get tonight. And I'll give you some examples later of that. All right, so, okay, and this is a really good one on humility. The only true wisdom is in knowing you know nothing, Socrates. And it's true that the reason why we get wisdom as we get older is simply because we've made mistakes and learned from them. It's not like we're smarter, it's just that we've gone through it. It's like we have kids, and we hope our kids, if they make mistakes, they make them early in life and not expensive, so that they can learn from their mistakes and still not lose a lot of time and money. So, all right. And to me, when you're dealing with real estate especially, and just in terms of finances for life, it's all about having a good team. Okay, so the first member in terms of the real estate team will probably be someone like Gene, the real estate agent. Okay, they'll be able to point you in the right direction. They'll be able to give you advice. They'll certainly walk you through transactions because they could be an absolute mess in a hurry. Okay, and connected to that, then, if you're owning real estate, is having a property manager. Some people don't want to manage real estate. Others feel very comfortable doing it. So, property manager is someone there. A loan broker. The loan broker is so important. And in my mind, the loan broker's job starts before you ever start looking at real estate. They sit you down. They talk to you about what's going on. They look at your finances. They look at your tax returns, your W-2s. They ask questions about, the longevity of your work and whether you're going to leave and all that kind of stuff. What are they trying to do? They're trying to come up with a profile for you to say, hey, based on what I see, these are your boundaries. And we'll get to boundaries later, but these are your boundaries. So that loan broker is a very important person in your life. And I'm sure, because you don't want to go out looking for property and then later, and you have your heart set on something, and later go talk to your loan broker and they say, well, you're crazy. You should have never looked at that property. You can't afford it. Okay. The next one is your financial planner, consultant. Now, for most of us, a financial planner is someone who's more going to take care of your stock portfolio than someone who's going to take care of your real estate. But they're still part of the team. Why? Because you need your whole entire estate to kind of be looked at and to be managed and understood. And he may be at odds and say, or she, and say, nah, let's stick in the market, forget the real estate. Well, sure, they want to manage their money, of course. But there is a good balance to all that, and they're a good person to still have, especially if they encourage you to get real estate when it becomes part of the picture. Then you know they're just not in it for the commissions and earnings. The next one is a tax strategist and accountant, and that would be someone like me. And so I've always felt that I am more valuable to my clients by what I keep them out of, more so than what I get them into, because they have different thoughts about what they can afford, what they can do, where they're going, and they need some truth talk, and sometimes that's what it takes. And you can't worry about offending somebody. You just need to help them, because the biggest problem they have is themselves. So most of the time, everybody's really receptive, and we have a great conversation. And at the end, they know exactly where they're going, how much they can, how much they could buy. And I just ask questions, probing questions about why they want to do things. I just want them to understand what those answers are. Okay, and the last one is an attorney. And attorneys are good in certain situations. You absolutely need them. So for instance, Grant Baker, who was a speaker last time, he is an attorney, and I've known him for years. I've worked with him on different projects. He's actually represented me for contracts and stuff. So what kinds of things do you think attorneys would be helpful for in terms of co-ownership, contracts? What do you see?
Let me just say that I think when I was speaking last time, a large part of my practice is litigation. When COVID hit, I actually had a $20 million shopping plaza close 2 days after the shelter-in-place order hit on 3/16. So I think it was like right at like last week of March, we closed escrow and the deal was fine.
Buyer or seller?
We had the seller.
Oh, good.
And it was a situation where my 90-year-old matriarch basically was, handed this property down to her 3 adult siblings. And what happened is that they closed escrow, and the siblings basically took each of their 1/3 interest and did a 1031 exchange and just shot the money out of state in other real estate investments. That's what happened there. But sorry, call of the question. What are we looking for? Okay, so first of all, let me just say something that Joe said that I cannot stress enough, and that is the importance of a really good real estate broker, because they do a lot of just the groundwork. They'll put together a lease abstract for leases that are like, I don't know, it depends on the size of the property. It could be a duplex for residential, could be, 4 tenants in a little shopping center. You never know, right? And so brokers will oftentimes take the leases and just break them down to a summary, which makes it really easy for the property or for the buyer, right? And so that's one thing. They'll also help order a phase 1 environmental report if it's a commercial property. Obviously, if you're buying an apartment complex, that's a non-issue. But for commercial properties especially, you always want to take a look at the lease agreements, because in commercial properties, you'll have long-term leases with options that the tenants can exercise by giving at least 6 months notice. That's sort of standard. No more than 9 months, but must have 6 months notice, because the owner needs lead time to market the property for rent, right? And you also have to look at options, right? Setting aside options. There could be right of first offers and right of first refusals. So like a tenant could basically have something in their lease that says, if you're going to sell the property, you have to make an offer to me before you take it to a third party. And we're going to have a time frame to get into negotiations. And if it doesn't work, then you could go out and solicit a third party offer. Right of first refusals are similar but different. Basically, if you get an offer from a third party, then you have to you have to approach the person who has the right of first refusal, give them the option to basically match it. So that's one thing.
So there's a lot there.
There's a lot in the lease, but then there's also components related to title.
Yeah, gotcha.
Title's another thing, right? There could be issues with encroachments that are existing, liens against the property, and every time you close, you want it clean. And also in out-of-state transactions, in commercial especially, you'll see where tenants' leases are recorded against the property, which is actually really helpful because title companies, you can press a hyperlink and the lease pops up and you can see it. So that's really great.
So that's the deal. So having a good team, all right. So they'll help you in a couple of different ways, and again, the slides will talk about it, but the first one is understanding risk tolerance. And like we talked about your broker who helps you with your stocks and bonds and portfolio, that's one thing they'll go over with you is they'll ask you a bunch of questions, and what they're trying to determine is how much anxiety does it take before you in the market before you start going crazy. So, when does that anxiety point hit? And that tells them what kinds of things they got to keep you out of, what kinds of things they'll get you into. As it relates to real estate, it's the same kind of thing to where some clients I've had to say, well, I want to go and I want to get some rental property. I said, well, I don't think you'd be a good landlord. Now, why? Because you're kind of a control freak, and when I tell you this about taxes, I could see you start to sweat, and I don't want you to go through any problems by owning real estate, because you're going to you're going to be asking the tenant, are all the light bulbs going? And there are some people who really just get really anxious about those things, and they should not be necessarily landlords. I'm just trying to help them. So that's risk tolerance. And then the other item is, we talked about before with the loan broker, is boundaries. Your parameters. How much property can you buy? With your down payment, with your income that you're right now that you're getting on a monthly basis, you can only afford X amount. So that when you go out and look for property with Gene, you'll know exactly the parameters that you're looking for. X amount of property. Unless the owner's willing to take maybe a carryback and you're willing to go a little bit higher. So those are the kinds of things that the team will help you. And obviously, if you run into other legal issues, you've got someone like Grant, and you've got your loan broker, you've got everybody involved. I'm usually involved with people with transactions also. So those are the kinds of things that you're dealing with. Okay, so let's go through, evaluating investment property, real estate. Okay, the first thing, everybody's always heard that, you've heard the whole term location, location, location. Location does make a big difference in how much, what a good piece of property is. Okay, so now I want to talk about cap rates as it relates to location and buying property. So what is a cap rate? Let's just say that, you're all ready to go out and buy property. And you go with your real estate broker, and they're not going to show you one property if there's open houses and stuff. You might see 5 or 10 different properties, and so now you're glazing over because you've got all this information and you don't know what to do with it. So cap rates, to me, has always worked for me to kind of help evaluate. Now, how does that work? What are cap rates? A cap rate is, and it's really short for capital. It says the equation is total rents for the year versus, in the numerator. Denominator is going to be value of the property. So let's take 2 examples. Now, so Jean takes you out and she shows you 2 homes. The first one, the rents are $3,000 a month, and the property is selling for $1 million. Okay, so 3,000 times 12 is $36,000 a year. Okay. So, 36,000. So, So then you've got 36,000 over $1 million. So that's a 3.6% cap rate. Okay. Then you got property number 2. It only has $2,500 a year times 12 is $30,000 for the whole year, but it's only selling for $750,000. Well, if you take that equation, that's a 4% cap rate. So in just a very short time, you're able to take 2 different properties and say, hey, I like this one because it's higher. Or you might want to say, listen, I have in mind that I want a cap rate of 4.5% before I'll even sniff at a property. So you talk to Gene and you say, let's make an offer on that $1 million property, but we're only going to offer them $950 or $9 whatever, something that will get you your 4.5% cap rate, because that's what you think the property is worth, and that's what it's worth to you, and that's all that's really important. So the cap rate really helps when you're evaluating multiple pieces of property. So when you're looking at location, that's the real estate broker. When you're looking at cash flow, probably someone like myself and the real estate broker will help you learn the cash flow. And by the way, the cap rate does not take into account any expenses. Now, that might be short-sighted, but I'm just giving you a tool to just simply evaluate. Potential growth, that again would be the real estate agent. Financing options, that would be the loan broker. Tenant selection, that would be your management company, or it may be you if you're going to manage your own property, and sometimes an attorney can help with the lease. Okay, and then risk management, again, depending on the situation, that might be if your financial planner, it might be the real estate broker, also might be the attorney.
So Joe,
Yes.
Before you continue, what are your thoughts in terms of location on out of state versus local versus in-state?
That's a great question. Okay, so we had invested in a couple of real estate properties around here, and my wife and myself. So we thought, okay, we'd heard about through a friend of ours that he had bought property in Texas. So we thought we'd try and buy some property in Texas. And it actually turned out okay, but because we were absentee owners, we were very much taken advantage of by the management company. And so I don't think they took as much time and care of the property simply because we weren't there. And so that was a lesson learned. That was a mistake and a lesson learned. We actually made money on all 3 properties because the property in Texas took off, a few years after we had bought them. But I was still a little bitter about the whole thing because I thought we had good real estate management. So that's one. Now, and we'll get into DSTs, and maybe this is a good time to actually go through that. Okay, so what is and I've spoken of DSTs before. What is a DST? DST stands for Delaware Statutory Trust. And what is that? It's like an LLC where many people are owners, except it's in the form of a trust. So what happens is a company buys, say, a property. So I'll give you an example. There is, and this is a true example, there is a glove factory in the northern part of Illinois. And it was $193 million. So, didn't have that kind of pocket change. But what they do is they buy the property, and then what they do is they set up administration and all that, and then the 193 is the price to us. They probably paid, I don't know, maybe 170 million or something. But so what they do is when people want to put money in, they buy pieces of that $193 million building. And the building is leased for the next, I think, 20, 30 years to the U.S. government, and they make the specialty gloves. It's not like latex gloves, it's a specialty one. I forgot exactly the goings on there. But people do 1031 exchanges and buy pieces, and they buy it through the Delaware Statutory Trust. So the whole property is set up as a DST, and you buy a piece of it. Now, the government pays for everything. So they pay the rent to us, they pay the insurance, they pay the property taxes, they pay all the repairs. It's basically like a triple net lease, okay? But the good part of the DST is, and certainly the rents go up as time goes on, they're able to give you a rate of return on your investment stated. And that's at the beginning, and it goes up from there. So this particular one is a pretty darn good one, and it's 6.4%. Okay, so basically, let's just say that, and I have this gal who we were talking about that went up to Fairfield for. She was getting a cap rate of about a little less than 2% on her money. So she'll turn around and she could put that money into something like this. I would say the average of the DSTs is probably mid to late 5s, let's say 5.5. So she could take maybe $500,000 and she'll get, $27,500 per year as a check, okay? No expenses, because remember, all the expenses are paid. Whereas before, she was probably ending up netting 10 grand, okay? The other thing is that when you buy properties out of state, and almost all DSTs are out of California, the depreciation changes. How does it change? When you buy property here in the Bay Area and you buy a rental property in Millbrae, chances are, at best, half of the purchase price is land value, half is building, and you're only able to depreciate the building part. Whereas if you're in Illinois, it's about 90% building, 10% land. So you could see you got a ton more depreciation. And the higher depreciation allows you to basically wipe out the income. So you're getting all this income, but it's being covered by depreciation. So you're really not paying very much tax on it at all. It's pure cash flow. So that's what a DST is. It's an incredible, to me, They're incredible investments. And here's the thing about DSTs too. You know, you talk about brokers going through the whole thing, and they say their big thing is stockbrokers is, you know, diversification. Well, with DSTs, you can certainly diversify geographically. Like the one I just had a guy who sold a condo in San Jose for $1.4 million, and he put it into 3 DSTs. He puts them in the glove factory, I think $500,000. Puts them into a place down in Temecula, which is interesting because it's California, and then another place in Silver Springs, Maryland, which was a care home. So he diversified geographically. But not only that, with DSTs, you could diversify as to industry. So one was a factory. This other one down here was a different kind of plant. The one's a glove factory, and the other one's a care home. So diversification is crazy in terms of the DSTs. Here's the thing. For my control freak clients who want to do everything about their real estate and know everything about it, this is a big awakening to them, that they're going to be completely hands-off. They have no control over it. And after a very short time, they get to like it very much. Okay, what are the negatives? Certainly properties have, you know, elsewhere and have the same kind of risk as any other real estate. The property can go down in value. Usually the leases are long-term, and they're normally guaranteed, you know, sometimes by U.S. government or outside parties. So that part is good, but certainly things happen, you know, and beyond the control. But it's, to me, it's a lot better than having a triple net lease on your own with one property. And I was talking to Grant about this before. I have a guy who owns like 5 or 6 Walgreens around the country, and he loves them. He loves the whole triple net lease thing. He's now looking into the DSTs. Why? Because he doesn't want to have to manage them. He doesn't want to have to deal with it. And the fact that they're giving you a stated percentage, and that stated percentage goes up as the rents go up. And generally speaking, even though those are 10-year deals from buying to selling later, they usually last somewhere between 5 and 7 years. And what happens is that, especially if the market's good, they will sell between 5 and 7 years, and you'll not only make this, you know, in the glove factory, the 6.4%, but you'll make whatever the capital gain is also. That's because you own the property. You own that piece of the property. Generally speaking, if you're going to get into a DST, you don't plan on selling it. Okay, you're going to be with it, and then when they sell the property, then you have another decision to make. Do you want to go to the next DST? Do you want to cash out? Do you want to do a 1031 exchange into your own property? But it's not a good situation that in terms of downside if after you get into a DST you want to immediately sell. Not a good situation at all.
Yes.
So,
one question.
yeah.
Your clients experience having to pay an entrance fee?
For DSTs?
Entrance fee.
No. So what happens is that, like I said, the property was probably purchased, I'm just guessing, the glove factory, for like maybe 160 or 170 million, and they're selling it for 193. So they're managing it, they're putting all the pieces of the administration together and all the costs of setting up the DST. When you get into it, when you put your money into it, that's, if you have $300,000 to put into it, you're getting a $300,000 piece of that puzzle. It probably already has a profit built into the people who bought it and are selling you pieces. And you might want to call that the entrance fee if you wish. But if you have $300 to put in, you're buying, and you know the purchase price is $193 million, you're getting $300,000 of that 193, and that's it. Yes.
Normally, are you able to get a mortgage or finance a DST, or do you have to?
No. So it's a great question too. So so here's the deal. Say you come out of an exchange and you sell a property for $1 million that had a $300,000 loan on it. Okay. Well, 1031 says you got to get a $300,000 loan on a $1 million piece of property in order to meet the exchange. You tell the DST people what you need, and you'll get it. So they have the loan already set up. They have what proceeds you're putting in, which in this case would be the 700,000, and they'll reverse it. So if they have a, let's say 40% loan to value and you're putting in 700,000, then you're going to buy 2.8 million or whatever I can't remember, the computation. You'll have enough loan to meet the standard of the 1031 exchange. That's getting into it with the broker. They'll help you to figure all that stuff out. Okay, so the next slide is going to be, your relationship with your particular real estate. So I would say I'm more on the hoarder side. My wife is more on the non-hoarder side. But it's good because we kept properties long enough to make some money on them and then sell them and do other things. But it's good to know where you stand on that. And as I've learned in the last few years, even though I was kind of, let's say, on the hoarder side, when you start looking at the cap rates as the property goes up in value, you get a little bit anxious because as the property goes up in value and the rents don't go up as much in terms of an increase, your cap rate is going down and you're not doing yourself very well. So that's why understanding cap rates and talking to consultants and stuff is really a great idea. So you got the metamorphosis changing, as you age. So
Joe, before you go
Yeah.
on, so how often would you say you should evaluate your property? Because you said you're a hoarder, so that means
Yeah.
you like to hold on to it, right?
Yeah, I like to hold on to it.
Yeah.
And I really didn't understand the whole concept. And here I was an accountant. That's what I do for a living. So I would say every 3 to 4 years, I would really do that, especially when your rents go up. Then you say, okay, now with this new rent, because a lot of people who are buying your house, if it's a rental, that's the first thing they look at is what your rent is. Why? Because they figure out the cap rate based on your new rent. So if you could raise your rent, then your value would go up a little bit more. So in your 20s, it's a growth period. Obviously, 20s and 30s and 40s, it's a great growth period. So whether you're single or married, you're generally going to have either rent or a mortgage. You're going to have leveraged property. You're going to have a lot more outlay just to live. Because you're either single and going out and doing stuff, or you're raising a family. You got educational expenses, whether it's you as a single person getting more education, going back to get your master's, whether it's you with a family with kids going to school. It's a time of complete outlay. It's interesting. When I was in my 30s, I was 39 years old. I bought a 21-year term policy, life insurance term policy. My whole thinking was, if I died before age 60, my wife would have some money to help raise the kids through the time when they were going to be in college. That was my whole thing. And I figured, okay, at age 60, my term policy went away. It was not worth anything. My thinking there was, if I can't do something with my life between now and age 60, then I've got a problem to begin with, okay? But we had saved and we did well, so at age 60, I no longer needed that term policy. So I don't own a term policy. I don't own any insurance at this point. But that's the kind of thing when you're in your 20s and 30s and 40s you think about is getting to a certain spot in your life to where you don't need the insurances anymore, and you can raise your family and do okay. Okay, so yeah, and when you're in your 20s, 30s, 40s, especially today, these kids are making more coming out of college than I made after 20 years after I was working. So it's like this high earnings years, and you would think, okay, if they could just put away 10%, it doesn't work that way, but but it's their money, it's their life. There you go. Yeah. So okay, there you go. And like you were talking about during that time, I think you could still put money away, and you could still do some other investing. I really do. Okay. Then you get to your 60s. Okay. So you're still in the market, but your investments, you know, your investments change a little bit. Your whole thinking changes a little bit. You start to investigate other avenues for investment. You know, well, okay, so if you're in real estate, you know, okay, you're evaluating your real estate. If you're in the stock market, certainly you can. Obviously, you're always evaluating that. And then there's other things like lender markets. And what is a lender market? Lender market is where you no longer own real estate, but you're the bank. So you loan money to somebody who's either doing a project or has a property that they need money, hard money loans. So that's the lender markets, and that's a great avenue. I have clients who starting to sell real estate and starting to get into the lender market stuff, you know. Some are getting 10, 12, 15%. So it's good. Okay, so, and then the other one I put at the bottom is, you know, paying off debts. So I have a client who sold a piece of property, did an exchange into another piece of property, okay? And the first property they sold had debt on it. So the new property also had to have debt on it. And this was last summer. So guess what? He had a 7% loan on that property. Not the best situation, but because he wanted to do the exchange and he wanted the property, that's what it came down to. Well, he happened to have another piece of property that he was able to sell. So, okay, so you say to yourself, the knee-jerk reaction is, well, let's put that into a DST or let's go buy some other real estate. No, because these people were in their 60s, he took the proceeds from that money and he paid off the loan on the one property that he bought and did the exchange. So now he kind of cannibalized the one piece of property, ended up with a little money after that. But the point is that he made the decision at that point to pay off the debt because he was in his 60s, they were in their 60s, and he didn't want to have that lingering debt on this other piece of property. And that's you know, again, for everybody's situation is different. And that's the evaluation you have to go through. Okay, I've got this $300,000 or $400,000. What am I going to do with it? Am I going to go into a DST and get 5%, say? $300,000, 5%, $15,000 a year, not real sexy, you know. But I got a 7% loan here that I'm paying off. How much am I earning on that money? 7%, because that's what I'm saving. So took the money and paid off the loan, and that's a great move. And I'm sure he's very happy with it. Now we get into our 70s. So let's go back to this person I know that is selling, you know, sold this property up in Fairfield. So situation was maybe 4 or 5 years ago. She lived here in the Bay Area, and her son lived in Texas, went to school over there at UT in Austin. So she decided with her husband to rent their property here in the Bay Area and move to Texas. So they did that. And within a year, her husband started to, you know, have some medical issues. And so she's dealing with that, along with managing several rental properties here in California. So here she was, you know, 75, 76, 77, multiple properties, managing all these properties, dealing with her husband's declining situation. And to her, that was crazy. So she called me and we talked it over, went through the different options that were there. And so she is now selling her properties and she's buying into different DSTs. And so what's she doing? She's in her 70s. She no longer has a desire to manage real estate. She just wants the cash flow. So she's selling her properties, doing 1031 exchanges so she doesn't have to pay any of the tax. And then she's buying the different DSTs, or, you know, she'll figure out something, either that or maybe another investment later because she's got multiple properties. We're just dealing with the first one. And that's the mindset of somebody maybe in their 70s. They no longer have the desire or the energy to be managing multiple properties. Yeah, okay, so she's looking for an exit. And frankly, you don't have to be 70 looking for an exit. I just spoke to somebody who, you know, their mom is in a situation where they're, you know, contemplating divorce, or she was divorced now, and she received some property. The ex-husband took some property. but she's in her 60s and she doesn't care about real estate. She doesn't want to manage it. To her, it's great. It's a little bit of cash flow, but it's also something that makes her very anxious. So we're going to be talking about selling the property and what the alternatives are. Going into the market, going into a DST, going into a triple net lease, whatever it is. But it's something other than her managing it because she doesn't want to. Anyway, so going back to the 70s. So another option is you just do 1031 exchanges. So the thing about as you get older, what you want to do, I think, is think about consolidating to simplify your life. Okay, so for us it was less properties to manage. So we did that. This other lady, it's less properties to manage and more stable cash flow. Okay, so that's it. Okay, so getting into the market when you don't have enough money. Okay, so this is where we talked about, like, if you want to do some investing and you don't have enough money on your own to get into a property, you can then work with other people, and then you could buy a property as a group. And in that case, I would really suggest an LLC, limited liability company, to own that property, and everybody owns their little piece. And you could talk to your attorney about why that's important. So when you do, you get a full cycle of when you're working. So in your 20s, 30s, you're buying property either yourself or with others. When you're 40, a little 10 years later, you're evaluating and maybe selling that property because it's gone up in value, hopefully, and then buying something a little bit larger. Same thing when you're 50. If you're in with somebody else, you can sell that property, and you can either, as a group, buy something much larger, because then at that point you have a potential multiple because you have more increase in value, or you can actually split up and go your own ways. You can each do your own separate 1031 exchanges. Obviously, you cannot do the 1031 exchange if the property is in an LLC. So you would have to drop out of the LLC for a period of time, and then each, as individual owners, sell that property. So that's what that is. Great. So that's basically involving with that, and that's your full cycle. And then when you hit 50, again, you do your 1031. When you hit 60, we talked about that, and 70, there you go. You're going to be evaluating what your next steps are, what your whole thought process is, whether you want to be managing property or doing something else, right? That's the whole point of retirement, is not to get more busy, but to do something else and let the properties work for you. You've worked your whole life to come up with passive income. Now let that passive income work for you. And this is a huge one too. Avoiding possible estates issues, okay? So with this property, I told you I'd get back to this property with these 3 Italian fellows in the city. So when I was 29, I was their accountant, and they were all in their early 60s. And so they had probably 30, 35 properties between them, okay, as a group, because they were all still one group. But one of the couples had one daughter, and she had some severe medical issues. And they were really concerned that when they passed away, that the other family members would not be as nice to her as they could be. So at that point, they approached me and said, listen, I think we ought to break up this happy party here so that we'll have, divide this property into 3 areas. And so, we'll take our third, but the problem was nobody would agree on which properties they wanted in their spaces. They're older guys, oh, I built that one, I put that roof on, I want that property. No, I built this, but I put the foundation, all the, and I was sitting there listening to this. So they said, okay, Joe, you're going to decide. And so I was really scared because I thought, oh my gosh, if I do this wrong, somebody's going to get mad and I'm going to get sued or something. So I said, this is what I'm going to do. I'm going to take all these properties and I'm going to divide it. I'm going to go 10 different ways. So I'm going to put little pieces of paper into a cap, and we're going to go 1 through 10. I think I did 12. So I did 12. And each one represented a group of properties. okay? So, and one guy, the guy who wanted out, he was going to be the one to reach in and pull out the one, and no matter what he did, that was going to be his one. But he was telling me beforehand, Joe, I hope I get the one that includes, you know, this one on Wisconsin and that one down on Carolina. This is all in the Potrero district. And so sure enough, out of the 10 or 12 that I had in there, he picked the one that he wanted. So we all started laughing. We had a glass of wine, you know, we called it Lucky Louie Day, you know, so because he got what he wanted. And to this day, then, you know, they've since passed away, but they had a trust, and I take care of the daughter and the trust. So, and that all came out of that whole thing, whereas those parents were concerned that the real estate holdings were going to be a problem because his daughter certainly wasn't going to be able to manage it, and they were just concerned about, not that the other family members didn't like her, but it would just be hard. It would just be difficult, and they wanted to make sure that she was taken care of. So that's a great example of a situation where, you know, solving a problem early enough that you know, you don't have that problem later. I have another person who owns several pieces of real estate, and he's been investing with his buddy, and they're two great guys, and I know them both really well, but they have probably 12, 13 properties together. And so this person, unfortunately, he's in his 80s, he fell and he broke 3 ribs, and he was in the hospital. So I went and saw him in the hospital. I talked to his daughter in the hospital and him. And we started to talk about, you know, you just got to kind of get things in order. And the daughter was really concerned that she did not want to be an owner with these other people. She liked them very much, but she didn't want to be an owner with them. So we're now talking about starting to do trades and just kind of separate the estates. And so that's the last point here, is to make it easier for heirs in the end to be able to not have to deal with this kind of stuff after the dad passed away, to take care of them now while he was living, and we could figure all this stuff out. So that brings me up to another good point is, if you're investing in real estate, 30s, 40s, 50s, 60s, 70s, get the kids involved. You know, just help them to understand what you've done, how you've got to where you were, and so as they grow older, they'll be able to do the same thing, or at least have a little bit of a head start. Now, when I say that, I don't mean just give them all the property, because you know, the power of what happened to those 3 Italian gentlemen is the fact that they did it themselves, and they learned the whole process from beginning to end. If someone had just handed that to them, they wouldn't have had that education. So get your kids involved, but give them also you know, a little bit of a lesson on how to do it themselves. So, okay. So conclusions. You know, you're never too old to own real estate and to do evaluations. You can't worry about the past except to learn from it. You know, like I say, I've made many, many mistakes. I learned a lot in the last 10 years about real estate, about my own abilities in that. So it's just things you need to learn. And the last thing I want to say is, I just said it a little bit ago, is you could be a little selfish in the sense of, you've done this, you know, for your lifetime. Enjoy it. You don't have to save every little bit for the kids. They will be okay. And part of the process is letting them grow up by making the same kinds of investments you did for life. And that's how they're going to grow.
Okay, well, thank you, Joe. We're going to close out.